With the Fed sell-off that we had in December, we reached extreme fear. Now we're just at fear. And again, it is suggesting that we're going to see a January rally. We're seeing a divergence between fear and greed with the S&P 500. We were at a reading of 32. With the Fed sell-off, we reached a low of 22, and it's now diverging with the S&P 500. You can see that here. I haven't read the S&P 500, which made a lower low, and the Fear Greed Index made a higher low down here at extremes, reaching 22 and now at a reading of 32, completing a divergence this past week. And I still think that the S&P is likely going to reach the upper channel line of the weekly chart, which could take us higher in our December 6th peak at 6,099. So I think we continue the rally and we get a blow off top. But momentum is still bearish. We got to see it turn back to bullish. And you couple this with the NVIDIA breakout that we had on Friday of the bull flag and the momentum turning back to bullish with Bitcoin that could help MicroStrategy, which is now on the NASDAQ 100. So NASDAQ 100 now has exposure to Bitcoin through MicroStrategy, which has a massive exposure to Bitcoin. Could this take the S&P 500 higher? Could help NASDAQ rebound. See if NASDAQ makes a new high. It did get that topping tail in the monthly time frame, so we'll be watching. But this is suggesting here the bullish divergence that we very well could begin to see a recovery if momentum signals turn back to bullish. If they remain bearish, the divergence could get larger. We can still go back and fill that gap at 57.83 on the S&P. Don't see momentum and trend signals all begin to turn bullish, then this could just be a bounce. But again, I think you got a pretty good shot with the divergence here and got with NVIDIA there on Friday, the bull flag. I think you got a pretty good shot that we attempt a rebound, a recovery here in January. We're also seeing something very similar to what we have with the Fear Greed Index on stocks above their 20-day moving average on the S&P 500. We saw a very large divergence at the December peak, a very large divergence with these other peaks giving us these downturns and this larger divergence setting up. This has given us a move back to extremes, very similar to what we had back over here earlier in the year. A larger divergence ended up setting up there in the first quarter, and that gave us a sell-off down to the April low. So again, could see an attempted recovery, move to new all-time highs on the S&P 500, but stocks above their 20-day moving average reached single digits with the Fed sell-off, and then got a higher low as the S&P moved slightly lower than the previous low that made with the Fed sell-off. We're also at extremes with stocks above their 50-day moving average on the S&P 500. It moved to a new low, though. There is no divergence, but it is at extremes under the 25 area. So unless the momentum and momentum signals begin to turn back to bullish, risk of more downside. But this extreme, again, could flip momentum signals back to bullish. If that happens, we could see the advance resume. Signals can turn back to bullish, momentum turns back to bullish, and it remains that way. Now, with the December sell-off, the risk-reward model has come back to extremes. It formed a divergence, a very large divergence from the July peak. It had turned down and it bottomed out just before the November election rally, turned back up, completed the divergence in December, and now down at extremes as we start the new year. So again, could we signals begin to turn back to bullish, still see the S&P reach new all-time highs, going towards the channel in the weekly time frame. But in order to get a rebound, we have to see support hold and momentum signals turn back to bullish. We don't have that yet. I talked about the momentum line is still bearish for the S&P. My last update, I talked about a bearish reversal of conditions in the daily time frame. Here, the risk model, we're still in a risk-off environment. The S&P trend is still bearish. And again, the risk line is also bearish. broken down from the rising wedge and back testing. We're now at the trend line of support, trying to bounce off of it, and again, our 20-week moving average in the weekly time frame levels can hold us support. Signals may turn back to bullish, and we could see the risk model turn back to bullish, moving back into a risk-on environment. But this is just giving us a bounce. You still have the gap fill there at 57.83, and you have horizontal support from the July peak down here at 56.70. So the risk is that we still get a bigger dump should we not be able to flip the momentum signals back to bullish. That's what I'm going to be watching for. The breakout with NVIDIA could help the market. Momentum for Bitcoin turned bullish on Thursday. That could help MicroStrategy and in turn help NASDAQ possibly recover. So the assets with the most volatility, NVIDIA, Bitcoin, their momentum is turning back to bullish late last week. Could we see that with the S&P and the NASDAQ? Now, in the upper window, I have the S&P 500 daily chart. In the lower window, I have the AD line. The AD line at the December 6th peak had a small divergence with the S&P 500. It's formed a divergence here right now. The AD line would have to get back above the 50-period moving average to resume the advance. That would really confirm it. If we can get back above the 50 and stay above it, is what could happen is if the S&P moves to new highs, as I think it will, I think it will make a new all-time high, reach the upper channel line in the weekly time frame. If that does happen, we could see a very large divergence develop, a larger divergence than the smaller one at the December high, a larger divergence develop between the S&P 500 moving to a new high with the AD line making a lower high. Please support the channel with the link directly below. That allows me to be able to provide you this information. If you like the charts, you like the indicators, let me know that by supporting the channel. If you could take a moment to do that, I would really, really appreciate it. Thank you for your consideration for that. Just follow the link below, take you to a secure site, and you can donate any amount you want. Thank you. We saw the VIX drop back below the 10, back below the 20, back below the 50. The 50 is still slightly above the 200 period, but we're turning down back below the 50. That could be suggesting that we see the bullish divergences that we had set up the very first day of the trading year that I talked about there on Thursday. We began to see play out on Friday on those 60-minute charts, those bullish divergences. This could be suggesting, again, that we get the January rally. We're dropping back below the 50 period. When you're above the 50 period, volatility is happening. When you drop back below it, then volatility declines on the S&P 500. So S&P is bouncing. The VIX is dropping. The VIX dropped by more than 10%. It dropped by 10.04%, back to 16.13. So we're back below the 50. But what that does mean is the VIX is predicting in the next two trading sessions, either Monday or Tuesday, that the S&P will have a down day. It's just based on historical data of moves on the VIX up and down of greater than 10%. An 85% chance we'll have a down day either Monday or Tuesday. That's all it's saying. I talked about the VIX very well could have bottomed before the S&P. The VIX could have topped before the S&P bottomed when we saw that spike in volatility. Now we're getting a lower high. Well, the S&P, this is the Fed sell-off right here. We have the spike in volatility, much like over here. That marked a peak. But right here, we're not moving to new highs on the VIX, but yet the S&P is moving to new lows. Here, they bottomed and topped at the same time, the S&P and the VIX. But I told you sometimes the VIX will top before the S&P bottoms, and now we have this bullish divergence on the S&P 500 and the VIX. The S&P closed just slightly above the 50. The VIX is dropping below the 50, but the VIX did not move to a new low. So again, it's very possible the S&P trying to bottom with that bullish divergence if momentum can turn back to bullish. And that very well could be the case. If momentum remains bearish, then all bets are off. And I'll be watching, do we stay below the 50 or do we get back above it? Watching the VIX next week. Now, if the S&P is going to try to form a little double bottom pattern here, and we're going to try to resume the advance. We got to see the momentum flip back to bullish. You got to get back above the blue line, the 20-period moving average, and then we've got to see a bullish reversal of conditions. The cloud has to flip back to green. The bars have to flip back to blue and remain that way and hold above that 20 period. So we'll be watching, and if we don't, if momentum can't flip with the bullish divergences that are forming, these little bullish divergences, then because we still come down to 57.83 and fill the gap or go down to horizontal support down here from the July high, and that would be 56.70. So those are the levels I'm watching if we can't get the traction back up. You got to flip the cloud here and get back above the 20-period moving average if we're going to resume the advance. S&P daily here. Now, as the S&P has been selling off since December 6th, dropped 4.5%. Watching my signals to see if they'll confirm a reversal there. And so far, we don't have that. This is the S&P up here. Volatility oscillator would have to get above the signal line and stay above it, not just above it, drop back below it. Now, if we get a bigger sell-off, it might come to this trend line right here and get above it and then turn right back down. Or if the S&P can bottom at the 20-week moving average and get that double bottom I'm talking about in the daily time frame, we start to see signals turn back to bullish with momentum. That may prevent volatility from going above the signal line and breaking the downtrend of a bullish falling wedge. And again, it may be we buy a little bit more time and get a run up in January to the upper channel line in the weekly time frame that I've been talking about. And as assuming we can bounce off this 20-week moving average, we did get a bottoming tail, a possible bottoming tail here in the weekly time frame for a possible hammer candlestick if we can rally back up and try to move either to backtest this broken trend line right here or get it back above it and move towards the blue trend line parallel to the lower boundary that I've talked about. And that could give us, again, another push higher here on the RSI and on the MACD to form a little divergence in the most recent price action. Allow the S&P to diverge with the Russell, possibly the NASDAQ, if the topping tail ends up holding up in the monthly time frame. And we've had about 9 weeks here where we have not been able to reach that upper boundary that I've been talking about, the upper boundary, the blue line there of the channel. We came towards it, but then fell short of it. I think we got a good shot of having that happen, and we very well could see a bottoming tail right here that could give us a January rally into that trend line. Trend line's the target. I've talked about moving to the high 6100 area if we reached it immediately. The further right you go to the chart, the higher the trend line goes. So now it's more towards the 62, 6300 range, into the 6300s, and depending on when we come into contact with it. But if we rally into the month of January, we very well could reach that trend line, and it could complete a blow-off top. It could complete a blow-off top on the S&P 500. But this December peak on December 6th is not being confirmed as a top yet. Now we're getting a hammer at the 20-week moving average here, and again a hollow red candlestick on top of that, which is tends to be a bullish reversal. So again, we could see a double bottom with this low here from the Fed, sell off, the rebound back up for the back test, and then again of the rising wedge on the daily chart, and this bounce now off the 20-week moving average could form a double bottom pattern here. They're seen on the intraday charts, the 60-minute chart, and the daily chart. But again, this candlestick very well could be marking a bottom at our 20-week moving average. And if so, we could see volatility turn back down. Now, volatility has not moved above the signal line, the S&P volatility oscillator, but we did move slightly into the negative region right here with the S&P trend direction. Now, that's what happened back over here. You move slightly negative, and right here, moving down just barely into negative territory there. Could we see something like that happen again, where we turn back up and we turn back down with volatility, and that gives the S&P the final rally, which is what happened in 2022. I talked about that possibility earlier for December, if we could see things turn up and turn back down and reach the objective target in the weekly time frame. We rallied, but we didn't reach the objective target, And then we got the December sell-off and the volatility oscillator increased. And again, when the volatility oscillator increases, you get above the signal line, then again, volatility sharply happens, and that is where we got the trend reversal over here, and that marked the 2022 top. So again, this is going to tell me when it turns that we're either going to get a bigger corrective move, or again, more than likely, it will mark a major top for the stock market. It will likely go negative and remain there. But here we went briefly negative, and I didn't mark it because, again, it turned right back up. We see something like that right here. So again, signals have done a good job marking the 2022 top, marking the 2022 bottom, and some corrections along the way after the 2022 low. But again, will it do the same here? I think it will. We couple that with the increase, the trend, the S&P trend with the volatility. If volatility firms a reversal, and again, I told you breaking this trend line and getting back above the signal line will likely do that, and then going into the negative region with the S&P trend direction and remaining there. We don't have that yet. We did move slightly negative here, but it's not being validated here with the volatility, that 20-week moving average. You got to take out that 20-week moving average if you're going to get a bigger dump on the S&P 500. I think the signal's been confirmed here at all yet. The December peak as a top, and I think with that bottoming tail and the hammer on the weekly chart at the 20-week moving average, I think that's suggesting we're going to get a rally in January. Some of the other signals that I mentioned, but right now momentum is still bearish. It's got to flip back to bullish. We'll see if that can happen next week. So I'll continue to monitor this. Do get a bigger sell-off, again, could get above the signal line, hit the trend line, and then turn. That's certainly possible. But again, that would mean we go back and fill the gap at 57.83 on the S&P. I think you got a good shot, that bottoming tail at the 20-week moving average. Very well can hold, and that can mark the double bottom on the daily chart of the S&P. Remember, we got a breakout on Friday on NVIDIA with the bull flag. The weekly momentum turned back to bullish with NVIDIA on the weekly chart. I think you got a good shot, momentum turning back to bullish on NVIDIA and back to bullish on Bitcoin, that the stock market will likely follow suit. Now, again, with the back test, we turned down, we created some of these gaps. We'll be watching the gaps. I talked about the gap support right here. We've slightly violated it a couple of times, but that's really formed this trend line, again, from the presidential election rally that we've had right there. We've come right to it, right on the nose there. Double bottom. You know, we could even set up a broadening formation if we rally to new highs. We could be setting up a broadening formation, you know, 1, 2, 3, 4, and then a 5. Could set up a broadening formation here. A 3 drives to a high pattern. I talked about that. If the head and shoulders didn't set up, we could go higher and set up a 3 drives to a high. Give us a broadening formation. We're hitting this level right on the nose. Look at that. But if we do end up going lower, we'll be watching the gap fill here at 57.83. Horizontal support from the July peak over here, 56.70. Our 200 period would be the measurement of the head and shoulders. That would take us down to about 55.61. Should we get a bigger sell-off? I talked about over here at the back test, it's possible that we drop several hundred points, you know, 200-300 points down to the gap fill or the horizontal support. So far, this gap support area seems to be holding. We've violated it a little bit, and that's taken us to this trend line. So, you know, something worth paying attention to is, do we have a broadening formation that's setting up? Should we form this little miniature double bottom pattern here? But again, momentum signals, they've got to turn back to bullish, and now momentum is bearish. So the risk is we still get further selling pressure. Momentum can flip back to bullish. We can resume the advance. Again, daily chart, we got to get oscillators back into positive territory. We saw the sell-off with the Fed. Some momentum tried to flip back test, but it reverted right back to bearish. And again, we got to see momentum signals turn back to bullish. This line right here represents the momentum. The cloud here represents the swing move, both bearish at this point. So we've got to see momentum turn back to bullish. We got to flip the clouds back to bullish. The advance is going to resume. We got to get oscillators back into positive territory if the advance is going to resume. If they remain negative, if signals remain negative, we can get a bigger sell-off. Gap fill and horizontal support are the next levels of support. Take that out, you got your 200 period moving average, 55.61 area. Be watching. Again, if we do get a double bottom, can signals turn back to bullish? Have some divergences on indicators. Not all the oscillators have a bullish divergence. Some do, some don't. Again, momentum is bearish. That way, we're going to go lower. We can flip it around. We could be setting up for a January rally, and the S&P could attempt to make new all-time highs. Now, listen carefully. Right now, signals remain bearish. Okay, that's what we have going into next week. Can that change, or will it remain the same and we get a bigger dump? VWAP support is interesting here. VWAP is the volume weighted average price. If we take the volume weighted average price from this higher low that's set up here after the August low, we're coming right into that. And it held as support. It held a support right here just before the presidential election rally. And right now, with the Fed sell off there and the back test, we've now come back to this area again, and we've got this horizontal support range. Again, this is the gap support area right in here. So we're at this support, and if we lose this support, then again, we can go back and fill that gap. If we go back and fill the gap down here at 57.83, then we're moving closer to the VWAP support from the August low and from the July high. That is the purple line from the August low. The red line right here is from the July high. If we lose this support, we don't form a double bottom, then we have this level right here and this horizontal support. Now, the sell-off that we've had since December 6th, we formed that triangle and we expected to pull back. We saw the divergences form on the 60-minute chart, and the triangle formed. And I told you the triangle can break up or down. We had a downward resolution with the Fed, and we ended up dropping about 4.5% now from our low this week. Seen a bigger sell-off with the Dow, about 6.6%. The Russell has dropped it's 11%. So again, we're going to see if we try to rebound. You got a possible little double bottom right here, but it was a 13.9 that gave us the sell-off. I warned you about that at the time. Again, it could be a reversal, just a pullback. I still thought we would reach my objective target in the weekly time frame, that trend line. Still think we're going to do here in January. Signals did give us this sell-off of 4.5%, just as the 9 count over here gave us this sell-off, to this 9 count gave us this sell-off. This 9 count gave us nearly a 10% sell-off there at the July sell-off to the August low. So again, these counts have done a good job in marking price exhaustion. We'll see if we get another new high, though, if we end up forming a little double bottom here at horizontal support. We're at this gap support area. This is the presidential election rally right here. And we've come up here and we've hit this level, and we've tried to bounce here. And if we touch these levels, if we touch these lows, again, we're bouncing off of the trend line right on the nose here and here. You still have the possibility of a head and shoulders pattern. If this rally fails, shoulders would measure down to the 200 period moving average to about 55.61. I'll be watching this round right here and see if we can recover. It is interesting how the 13 and 9 gave us this sell-off. This is a daily chart. Continuing to monitor the 2-week time frame, and again, this is something I normally don't share with you, but it's something I watch all the time. 1 week, the 2 week, and the monthly, along with the daily chart with sequence counts. And I'm looking at this 13 we got, and we have now potentially a 9. Get 1 bar every 2 weeks, and we've had the first week here with our 9 bar. Next week will be the second week of this 2-week bar. We'll end on January 10th. Before the CPI, and is what I'm watching to see if the 8 or 9, or the 8 was not the high of the count, the 7 bar was, the 13 there. Can the 9 be the high of the count? Even if it's not, you still may go higher. You may not have the 9 count be a perfected signal, but still may end up going above bar 7. But if we can rally going into next week, you might have the 9 bar, the high of the count, and the S&P might be trying to make new all-time highs. But I think that this count is worth watching. Pointed out the 2007 top was a 13. The 1929 top was a 13.9. Went a little bit higher, and then it turned. Something worth paying attention to, given we're at the long-term trend line in the monthly time frame. The S&P 500 and the NASDAQ 100. NASDAQ 100 turned off of it and got that topping tail in the monthly time frame. So is that a major top watching? But could it be NASDAQ has peaked and S&P has not? They diverge. Sometimes that happens. Something I'm watching here, this 9 bar, and next week we'll complete the 9 bar. As long as we don't close below the bar from 4 bars ago, which is right here, and we tried to do it at the lows of this week, we rallied up off of the 20-week moving average. Watching this count, I'll be monitoring it in the month of January. NASDAQ has the same count. NASDAQ 100 has a 9 count. It is a perfected signal because bar 8 was the high of the count. Remember, NASDAQ made new highs in mid-December, while the rest of the market, the Dow, S&P, they peaked in early December, at least so far. In the 2-week bars here, going to be watching. The 8 or 9 bar has to be the high of the count, so it very well could be a perfected signal with the 8 bar being the high of the count. NASDAQ cannot make new highs. We'll be watching. Another thing worth paying attention to is the NASDAQ weekly chart. This is the weekly chart, not the 2-week now, but the weekly chart. We had a 9 count in play, but it got canceled out in the weekly time frame because this week's bar closed below the bar from 4 weeks ago. 1, 2, 3, 4. We closed below it, and so the count got canceled out. Still in play is a 13 count if we can rally back up. And again, we did get a bottoming tail in the weekly time frame surrounding that 10-week moving average, and S&P is trying to bounce off the 20-week moving average. So again, the 13 count, there can be interruptions. With the 9 count, there can be no interruptions. The 13 count stops and starts. Each bar has to be above the bar from 2 bars ago on an intra-week basis. Count is on a closing basis. We have a 13.9, and again, we went a little bit higher, and then we turned, and we had a 9 count give us a pullback. They just show price exhaustion. Could we complete a 13 count here and still get a lower high, or maybe we go up and get a higher high? We're turning off the trend line, though, in the monthly time frame, as I've talked about. That topping tail in the form of a gravestone doji. I'll be watching to see if it's confirmed in the first quarter here during the month of January. We got the topping tail in December for the monthly bar, 1 bar per month. Just something to pay attention to. Again, that 9 count in the 2-week time frame, and then perfected signal already, and then this potential 13 that could develop here on the weekly chart in the coming weeks ahead here in January. If we get a bar that closes above the bar from 2 bars ago, it will be a 13 count down signal. 13 count does not have to be the high of the count. It just has to be above the bar from 2 weeks ago, above the intraday high, or intra-week high, I should say. So we'll be watching that. This is the NASDAQ weekly chart. Possible 13 count in play, and on the 2-week, a possible 9 count in play going forward here in January. So I'm watching these weekly charts to see if we'll attempt a recovery off of the moving averages. Again, the Dow, same thing. We're trying to get a bottoming tail here around that 20-week moving average, just like the S&P 500. If we can rebound, can the Dow get a lower high, maybe back test this trend line, or do we get above it and do we diverge, end up diverging, going back up and hitting the trend line, diverging with the transports as I've been talking about? That's a possibility as well. We have a larger divergence from Dow's 2022 high with the transports. The transports did not make a new high, did diverge back in 2021 and 2022. It peaked at that time, they diverged. Does it do it again? I'll be watching to see what becomes of this here with the weekly chart with the Dow. We could get a divergence also in this most recent price action right here. So again, we'll be watching to see if we get an attempted recovery. Again, we've sold off in December. We peaked it on December 4th. We sold off into early January now. So again, the whole month was just a slide back down to this 20-week moving average. But now from our peak there, we've now been down for 5 weeks. Watching to see if the Dow gets a recovery. If it does, even if the Dow doesn't make a new high, now S&P is likely going to. Dow sold off 6.6%, and again, it's hovering around its 100-period moving average. Still, that's a pink line. You can barely see it there because of the other trend line, but got a possible little miniature double bottom here on the Dow. If we can get the traction back up, I've drawn a parallel boundary here. Upper boundary, we'll see what becomes of that. You got a good shot of a rebound. Again, the stochastic is trying to turn back up, forming a little Class B divergence here along with the histogram. Again, almost 2 equal lows there, getting that little miniature double bottom on the Dow. Same thing with the RSI right here. So again, we'll be watching to see if we can get some traction up now going forward. And if we do we get a lower high, a Fibonacci retracement, or do we try to make a new high and hit that upper channel line in the weekly time frame? Back to the weekly chart again. If we get a bigger sell-off, you got to decisively take out this 20-week moving average and have the RSI drop below 50. Notice we had the RSI get above 50, and we moved above that 20-week, and we've had this, and we've been firming up just above that 50 level on the RSI. So again, in order to terminate the rally, as we did back over here, you got to get a 20-50 sell signal where you got to drop below the 20, and then the RSI has to drop below 50 and then stay there, and again, consistently be in that negative region, and pull-ups to the 50 area. That's where the counter trends develop on the price chart here in the weekly time frame with our RSI. So again, going to be watching. Do we trigger that signal, or do we rebound back up and get a lower high, or possibly a divergence and go up and hit that trend line again? We'll see what happens. The multiple point divergences, though, and this is telling us that and each one of these downturns on the RSI has given us some volatility, like what we've had here with our sell-off back to the 20-week, telling us that a major reversal is coming. Multiple point diversions here on the RSI. Similar story here on the Russell. Again, I'm watching to see, does a Russell get a 20-50 signal? Here it's trying to get back above that 20-week after having dropped below it. I talked about it. The Russell did go a little bit lower. We have this trend line right here. See if that's still the case or not. But we're going to be looking for a divergence to develop very similar to what happened over here, where we sold off from the 2021 peak, went and got a lower high, and stalled at that 20-week. And again, here, maybe we're trying to get back above it. But so it may not play out the exact same way, but very similar. We get a lower high here is more of a feeble rebound, just back up to that 20-week moving average. But then we saw the RSI go into the negative region, and again, you got your 20-50 sell signal here in the weekly time frame, and this happened. So again, watching these RSIs on the Dow and the Russell, now that they've had pretty good sell-offs to the downside, but my guess is we're probably going to recover, and I think that'll take the S&P to a new high. We'll see if the Dow can do it. I think the Russell's peaked. Both the Dow and the Russell did turn off of their trend lines right here, but as I've said, oftentimes the small caps and the large caps, the Russell and the S&P, they diverge at turning points, as they did back over at this top over here. Russell, again, formed a little divergence, didn't quite reach that lower boundary, but again, maybe it's close but no cigar. We'll see. We've dropped nearly 11% here. Got a little bullish divergence. It was a bearish divergence that tipped us off to the sell-off. I talked about that at the time, along with the divergence on the Dow. We also had it here on the MACD. Again, bullish divergence on the histogram, bullish divergence down here on the stochastic. My guess is you're going to get a recovery here in January. And again, maybe it's already starting now with the bottoming tail that we had earlier in the week here on the Russell and on the Dow. Dow and Russell can recover for a lower high, or if the Dow could try to make a new high. I think Russell probably won't. S&P can move to a new high. Here's that divergence between the Dow and the transports. I was talking about the Dow a minute ago. Again, the Dow moved to a new high. If the Dow can recover and the transports, and they both got little bottoming tails, got a little doji on the transports, more of a little hammer on the Dow. If they can recover, does the Dow go up to that trend line and hit the trend line in the weekly time frame, and they diverge in the more recent price action? Do we see something like that happen? They did diverge back over here. We'll see what happens. And they have this larger divergence. Why is that important? Because, again, the Dow could be forming a major long-term Dow Theory sell signal. Dow's moved to new highs, but the transports have not. In Dow Theory, it's the tenets of Dow Theory, the principle of confirmation. They have to confirm each other. Something worth watching.